Using your ISA allowance is a great way of building a tax-efficient savings pot, but should you have a cash ISA or an investment ISA? And what about the personal savings allowance? How does that work, and how should you save and invest your money to take advantage of tax allowances and avoid dividend tax and possibly capital gains tax? As always, with questions about personal finance, there is no one size fits all, as everyone's personal circumstances are different. But there are some important facts that you should consider, as they may impact your decision or choice. I'm going to talk to you about a client of mine who came to me with several investments and government savings plans. She also had £50,000 in a cash ISA and £50,000 in unwrapped investments. When I say unwrapped investments, I mean money invested in stocks and shares, but not within an ISA wrapper or within a pension wrapper or a bond. So they're liable to both dividend tax and capital gains tax. Now, I wanted my client to be aware of the projected tax bill for her £50,000 general investment portfolio over the next 3 years. So I started by looking at dividend tax. Now, I'm recording this video in February 2023, when everyone has a dividend allowance of £2,000 a year. Any dividends received from investments above that amount are subject to basic rate dividend tax of 8.75%. So, assuming a dividend yield of 2% on this lady's portfolio, this tax year dividend income will only be £1,000, which is within her allowance. From April 2023, the dividend allowance is reducing to just £1,000. So, if my client's portfolio continues to pay out the dividends as before, she's going to become liable for dividend tax. She will most certainly have to pay dividend tax from April 2024, as the allowance is reducing again, this time to just £500. So by year 3, if not before, she will be paying at least £44 dividend tax on her portfolio. The second tax general investments are liable for is capital gains tax, which arises when you dispose of a chargeable asset. Currently, for basic rate taxpayers, 10% capital gains tax is payable on gains made above the allowance of £12,300. So it's generous enough to avoid my client having to pay any capital gains tax at the moment. Remember, you have to actually sell an asset to have to pay capital gains tax. Even if you've made a profit but you haven't sold, there's no capital gains tax to pay. The government seems to be hitting investments quite hard with tax legislation, and the capital gains tax allowance is reducing to £6,000 in April 2023 and then to £3,000 from April 2024. On my client's £50,000 portfolio, assuming growth of 6%, she will have to start paying capital gains tax from year 3. Obviously, if she sells, as I said before, or sooner if the portfolio experiences significant growth. So what are her options to reduce her tax bill? So in this scenario, she should consider switching her cash ISA to an investment ISA. She can do that within her current ISA allowance because she's not actually adding any more money to her ISA. She simply needs to change the type of ISA from cash to stocks and shares. The second part of the plan is to withdraw the full £50,000 from her general investment portfolio and open a cash savings account. As a basic rate taxpayer, she benefits from the personal savings allowance of £1,000, which means that she can earn £1,000 interest on her savings before having to pay tax on it. Now, based on current interest rates for fixed term savings accounts of around 4% as of now, February 2023, my client could have £25,000 in a savings account without having to pay any tax on the interest. Total interest on £50,000 would be around £2,000 a year. So isn't she still liable to pay income tax on that, I hear you ask? Well, most basic rate taxpayers would be liable for 20% income tax on the remaining £1,000 worth of interest. But there is another way to avoid paying interest on your savings if you have fairly low earnings, which this particular client had. The starting rate for savings allows you to get up to £5,000 of interest and not have to pay tax on it. The more you earn from other income, for example, wages or pensions, the less your starting rate for savings will be. If your other income is £17,570 or more, you're not going to be eligible for the starting rate for savings. But my client only had pension income of around £15,000 below the £17,570 income figure where you can earn additional savings interest tax-free. Your starting rate for savings is a maximum of £5,000, and every £1 of other income above your personal allowance reduces your starting rate for savings by £1. In my client's situation, the estimated £2,000 worth of interest she's going to earn from her £50,000 savings should all be tax-free. This kind of planning can be particularly useful if one partner in a couple, a married couple or civil partnership, is a lower earner than the other and is therefore able to take advantage of these savings allowances, or transferring money from one to another. The upshot of making these changes to her portfolio is that both her investment portfolio and her cash savings are now completely free from dividend, capital gains and income tax as the rules stand currently. She has also still maintained the balance that suited her financial plan of £50,000 in equities and £50,000 in cash. Thanks for watching. I hope you've enjoyed this video. If you have, please press the like button and of course subscribe. I have other videos on the state pension, so again, check those out. If you do subscribe, I'll let you know of new videos as they come out. My name is Justin King. I'm a chartered and certified financial planner. My aim is to help you live a successful life that often involves understanding your money. I host a podcast called the Retirement Cafe Podcast. You might like to tune into that. Check out the description below, or you can sign up for my weekly newsletter, which was packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.